And just to give you a sense for how this works, some of you are clients of mine already, many of you are not, and how this works is that quarterly for our clients we put together a coaching seminar, something where I can spend a lot of time and in conjunction with the groups that we invest with, put a lot of effort into a big meeting. This doesn't mean you can't come in and talk to us personally. So this doesn't replace any of that. But this is a way that you can see each other, talk to each other, learn from some of the collective data that we can put together if we spend a lot of time on it. And so the quarterly coaching meeting starts right after dinner. And this is the introductory meeting that we give for new investors every time we do one of these. We start at 5:30 here. This is a seminar that I've given, I don't know, 150 times. I really like it. It's very accessible and helpful. So you'll enjoy this. And then you'll start to see people trickle in. They're not late. They're just here for the second half. And many of my clients like to come and hear this one over again, which you're welcome to do as well. So I'm glad you're here. I'm going to start with a few terms. And if you have a pen handy and you want to write some of these down, I tend to throw these terms around, and I want to make sure that for everyone they make sense. I know you've heard them before. One of the things we talk about all the time is the S&P 500. The S&P 500. This is a measurement of the market, and it's the 500 largest companies in the United States. And it's a good index, we call it, of the market. It tells us, is the market going up or down? Well, we just track the S&P 500. So I'll compare a lot of different returns to the S&P, and I'll call it the S&P, and that'll save us a lot of time. We'll talk about index fund, and we'll talk about active funds. So index funds versus active funds. Index funds are funds, mutual funds, which I'll get into too, that are put together formulaically. So there's not a manager that tracks these. It's a formula type fund. An active fund is not based on a formula. It's based on a manager picking stocks, buying and selling stocks. And both of them are mutual funds, so they both come into the category of mutual funds. A mutual fund is a company that you can buy shares in that owns multiple companies. So a mutual fund is a fund of many companies, many stocks. And an active fund versus an index fund is what we're going to be talking about tonight, so I wanted to give you a little bit of an overview there. And then lastly, just a couple of simple ones. We'll talk about stocks and bonds. Another way of putting that is we'll talk about equities, and we'll talk about fixed income. So stocks or equities is ownership in a company, and bonds or fixed income is when you lend your money to a company or to the government. So when the government buys a bond, or when you buy a bond from the government is borrowing your money, and then they'll owe you a return. Okay? So we'll talk about that as well. There are more. I'll try to go slow. There are two types of people in the room, people who really love this stuff and people who are here because the person they're here with really loves this stuff. And I really want to make sure that it makes sense for everyone that's here. And I'm sure this one will make a lot more sense than many of the investing seminars you may have heard. So this is called Separating Myths from Truth, the Story of Investing. And Charlie, if we're live, I think I've got green lights just about everywhere I'm looking. So that's good. This will be online again later. Okay, Separating Myths from Truth is a three-part seminar. We'll dispel the traditional investing myths, we'll tell the true story of investing, and we'll give you an opportunity at the end to fill out a card. We're very low pressure, but we want you to be able to access us, and we want to do that in a systematic way so that we don't leave anyone out that wants help. So the dispelling the myths. A myth is a story that's made up to explain a phenomenon that's beyond the science or the information of the day. And the example is probably the best one I always give it is when back when we thought that the Earth was the center of the universe. We didn't have information to say differently. The Catholic Church at the time was just going based on the Bible. The sun rises and sets. We see that the sun rises and sets, and so we think the sun is moving, right? It's rising and it's setting. We don't feel like we're moving. It must be that we're the center and the sun revolves around us. We find out later through prisms and mirrors and key excommunication from the Church of Galileo that this is not true. But it took quite some doing to change the structures, right? To change the belief system. And that's going to be similar here. We have a lot of evidence, and yet we have practices that go against that evidence. We're going to talk about these 4 myths. Stock selection, track record investing, market timing, and the cost of investing. And I'll ask you to open up your little booklet. You can follow along as we go through some of this. This is going to be on page 3. And I may forget to keep moving you along, but keep following along, and the numbers and pictures on the pages will match up here pretty well. I'm often asked, what do you do? I was just on an airplane not too long ago, and someone asked me in the airport, so what do you do? And I said, I'm an investment advisor. Okay, great. Should I be in the market or out of the market? Is a question I often get. Well, I don't know, I say, and they say, well, what's a good stock? You're gonna keep Apple now that Jobs is gone. You're gonna keep Apple long term. I said, probably. I don't know, and kind of get a perplexed look on their face. And then they talk about, well, mutual funds. Is there a good mutual fund out there? Is there a good sector out there? And I say, well, I don't know which one I would, over others that I would choose. And they kind of look at me funny as if to say, now what it is you said that you do again. And these abilities to predict and these stock picking abilities are essentially what people think of this industry. The industry presents itself in such a way, and not only that, but the news media presents itself in such a way that it almost tries to condition you that you should be able to work with someone who knows these things. How badly do we want to know something before it happens? And we even want to know who's going to win the football game before it happens, and they're almost always wrong. But these are the myths. We're going to go through them one at a time. Stock selection is the first one. And stock selection is defined as choosing a stock that we believe will do well in the future. So far, so good. We want to buy stocks that we believe will do well in the future. The myth, though, is that an investment advisor, and I would include investors, and I would include money managers and mutual fund managers, that they can predictably add value to your mutual fund by exercising superior skill in stock selection. That one mutual fund manager or investment advisor can beat another one. Okay, and this is a myth that's been propagated. Let's start with some factual information. This one's not in your book, but it's interesting. This, since 1923, when the first mutual fund was born here, tracks the number of mutual funds total and all the number of new mutual funds in a given year, and then eventually some of the dead mutual funds that start to show up, the ones that are killed. Okay. Now, in that entire period of time, all the way through 2011, 2012 information's coming in, you can see there's a growing trend that's not all that exciting. The number of new mutual funds in 2011 were 2,261 new mutual funds in 1 year introduced, and 1,568 of them were killed. It's no joke that 2009, right after the 2008 year, 2,600 of them were killed in 1 year, and then a bunch more in their wake. Coming in new, and a number more killed every time. So every year new funds are born, every year funds are killed, and the total numbers, if you add them all up, since 2011, in 2011, 27,734 mutual funds were there for your choosing. The total number born since 1923 was 49,300, and the total number killed were 20,915. Now, an interesting fact about the killed mutual funds, or the dead mutual funds, is that those returns are no longer found in the prospectus. Okay? So when you hear something like X and Y percentage of our funds beat their averages, their Lipper averages, or beat the market, it's the mutual funds that exist today that they're talking about. You can get this information, you just have to pay a lot of money for it. We went to the Center for Research and Securities Pricing, CRSP, CRP, we'll talk about that a little bit as well, and we got the information on all of the funds, and specifically we found the 200 worst mutual funds, and their average return from inception to being killed was negative 77%. And this information is not in the information that you're using to purchase mutual funds right now, because they don't have to report on funds that they don't have open for sale. So if they don't have a fund for sale, they leave it out and they kill mutual funds for various reasons. This is certainly one of those reasons. So stock picking is skewed, and we can get the information, and we put it back in. So the benefits of stock picking. The average U.S. equity mutual fund, and this is in your book, might be page 4 probably. If you look at the average U.S. mutual fund on the bottom number here, the return of the average U.S. mutual fund is tracked here. And this is U.S. equity fund. So it's a mutual fund consisting of equities only, stocks only, not bonds, and consisting of U.S. companies only. So it's not all 26,000 funds. It's just the ones that are U.S. equity funds. And if you had invested in 1972 $100,000, the average of all U.S. mutual funds would have given you $2.056 million at the end of that period if you had invested in an index of the average of all of those. Now you compare that to the S&P 500 in pink, or the CRSP market, which is the entire market, and the market did far better than the average of all U.S. mutual funds. The wealth lost to active stock picking, active management versus indexes. These are indexes. This is an active conglomerate, the average of all. The wealth lost to active stock picking was $1.6 million over that period of time. You don't see that information. That information is not produced in the prospectuses because the prospectuses don't track dead mutual funds. But this is real. We took the average of all mutual funds and we put those in the matrix as well. And the average of all mutual funds, now this would include international funds, it would include bond funds. So it would include the emerging markets, the way out there, more aggressive stuff. It would include the very conservative stuff. All the bond funds as well. So all 26,000 some mutual funds, 27,000 that are available, are in this average all the way through 2011. And $100,000 would have grown to 1.2 million. You'd have expected that to at least come in above our average return, or our conservative return. Our conservative fund took $100,000 during that same period of time, and a mixed based on our conservative fund would have achieved a 3.1 almost $1 million return. And this one has 25% stocks in it. This one's probably at least 50-50 stocks and bonds, and it does far less well when you put all of the data back in. And then the most aggressive fund, although very volatile, probably not something that you want to retire with. This would be much better for a retirement portfolio. But someone who's younger and has years left, you can handle that. And the returns that are there from the market, from the pure market, are far better than the average of the returns from all mutual funds, including the active traded funds. Does that make sense? So the wealth lost to active stock picking versus just the pure market, where the market does the work, the S&P 500 or the CRSP 9 through 10, or an index, a set of index funds that's mixed together for different weights of being aggressive versus conservative. Active funds underperform significantly the market. So this brought me to asking the question, more than a decade ago, we need a better manager, or we need to look at the good managers. I don't want to look at the managers who lost their mutual fund because of performance and it was killed. I want to look at the best ones, just the ones that have beat the market and the ones that did the best. And so we look at myth 2, called track record investing, and it's defined as the use of performance history to determine the best investments for the future. So if you're looking for a mutual fund to purchase, and you're looking at the name of the fund, and then you're looking at the information that comes just to the right of that name, what is the information that comes just to the right of the name of the fund? It's the information on how the fund has done in the recent, since inception, 1 year, year to date, 3 years, 5 years, 10 years, 15 years, if it's been around that long, right? That's what you see. And this track record information is essentially what we get as investors when we're looking to make decisions in our 401k. And it's incredibly deceptive because the fact that it's printed there, and by law it has to, this is your government, again, FINRA, saying, hey, let's help out the investor and give them more information. So they give you 2 pieces of information. Number 1, they give you all the track record investment information for every fund that you want. And then they give you a disclaimer. What does the disclaimer say? Past performance is not a predictor of future results, right? So they give you 2 pieces of information that completely contradict each other, and they ought to. The myth is that you're finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. This is a pure myth. To say that some people have done it for short periods of time, beat the market, is not to say that it's a method that makes sense for investors to use, and I'll show you what I mean. In your book, and I'll get you the page number here, you've got 2 big green boxes. And This blue box covers this one, but I'm going to direct your eyes to the green box on the left side of your page. Subsequent performance of top 30 mutual funds. Now, at the top of the heading, it gives you a couple of 10-year periods of time. And these are 10-year rolling average periods of time. We have done this over a 20-year period. You take any 10-year rolling average period of time, and you will get results like this. And we can go back on any one. But this ended year-end 2011. 2012 data is coming out here in a few months. But from 92 to 2001, the 30 top performing mutual funds are listed. Fidelity Select Electronics Portfolio, all the way down to Vanguard Prime Cap Fund Investor Shares, and everything in between. And their returns for the annualized returns for that 10-year period averaged are listed, and their rank. And this is a rank out of 27,000 mutual funds. These are the top 30, and they're the top 30 for a reason. If you look at the little bottom section there, or here, the top 30 funds averaged 19%. The S&P 500 did 14%. The total market did 13%. And the all funds average return did 11. So all mutual funds, again, fully underperformed the market, as you'd expect it to do. This includes all the underperforming funds. The top funds did 19. If you look here at the very best one, they did 28. They killed it. And guess what they were doing? They were comparing themselves to the market, to the S&P 500 when you came in as an investor to buy, and they said, look, we've got 30 mutual funds you can choose from, or some scattered group of these, and you could put these in your portfolio. But you didn't get this list in 1992, right? You got this list in 2001. And if it were 2002, there would have been a different list. There would have been somewhat the same maybe, but by and large, there would have been different information on it. Now, the question really is, because you bought this in January of 2002, the question really is, what happened since you owned it to these top 30 mutual funds? Because if we want to try to avoid being on that bottom 200 list where we have a negative 77% return, we want to go to the best. So we go to the top 30 from a production standpoint and a return standpoint funds. Well, look at their production the following 5 years, now, or 10 years. Now, granted, this was a rougher period of time, but the point is, these top 30 funds underperformed the S&P 500 by a full 2%. Not to mention, these funds cost more to own than an equity index does. You could have simply owned the index for that next period of time. The point here is almost nobody gets this return. When does all the money come into a top performing mutual fund? After what? After it performs, right? And almost nobody gets it. A few investors get it because they started the fund. Some money is in there, right? Those investors got it for a 10-year period. But most investors come into the top performing funds 5, 6, 7 years after it gets 5 stars. And its days are numbered right at about that period of time. And yet that's the information that they're using to sell you on using those funds. And so we chase after those 5-star funds and lose as a result. The next page, I'll show you a shorter period of time. This one's even more detrimental because both periods of time were positive. If you look at the top 30 funds on this one, you can read it a little better in your book maybe. A couple of different names will jump out at you. If you look at it, you see a lot of natural resources and energy, and you see some small cap or micro cap, right? This is simply a period of time, a 5-year period of time where energy funds did well and small companies did well, okay? But we come in after that period of time. We look at a 5-year period of time, beginning of 2006 to the end, or 2002 to the end of 2006, 5-year period. We look at the best funds. We see the S&P 500 did 6.83. This fund did 41. Why am I not jumping all over that? I mean, that just makes a ton of sense. It is hard to ignore. It's hard to ignore 41% when the S&P 500 did 7%. But this is a U.S. Global Resources Fund. This is an international fund. International generally always has a return different than the U.S. But if we're jumping on it afterwards, right, rather than diversifying it into our portfolio and leaving it there and rebalancing, if we're jumping on it afterwards, what do you think is going to happen? It had its run. Now it's going to ease off a little bit. When the S&P 500 is doing 4.3 and the average of all mutual funds in that top 30 list did 1.24, you again would have done better in the S&P 500. It is always the same. It's never different than that. The S&P 500 always beats the average of the top 20 or 30 top performing mutual funds of its previous 5 or 10 year period. And again, you don't get this information in 2002. You get it in 2006, end of 2006, 2007. And almost nobody gets this return, especially on a 5-year period. They don't, a 3-year track record of beating the market, people don't get real excited about. You beat the market for 4 years or 5 years, and now people start to jump in, they start to throw their money in. Well, all the people that threw their money in here, well, how long do you think their money sat in there? And then what do you think happened? They were unhappy with their expectation of 41%, and they're getting a 0.01%. So what do you think they did next? They went back and said, I'm not happy with this one. Give me another one. Well, how do you think they chose it? It's the only information they're given. So you buy 5 mutual funds because you want to diversify. You're happy with 2 or 3 of them, or at least they don't really stink, so you keep them, and 2 or 3 of them you get rid of, and you get it from the 5-star list again, and we constantly turn this thing over. The average holding period for mutual funds is less than 4 years, and the average investor does less well than the market, as we'll see here in a few minutes. So track record investing is a myth, and the key here is that a manager's ability to choose stocks in the past is correlated at a statistical 0 to his or her ability or the team's ability to pick stocks again in the future. Peter Lynch did it. He did it 11 years out of 13, from 79 to 82. 11 out of those 13 years he beat the market. Legendary status with the Fidelity Magellan Fund. His life was in shambles at the end of it. He decided to make a change for his family, and he decided to put a team together. His team has never yet had anything near the results. Fidelity Magellan has slightly underperformed the market ever since then. And there are economists and scientists who believe, mathematicians who believe, that Peter Lynch knew how to beat the market. That actually, I've been told, takes 64 years to actually prove. But they believe he could do it. They believe he was smart enough. But the fact is that's irrelevant to any of you, because even if it is true of somebody, you had to meet them in 1979, at least 1980. You had to meet the right one. And they're not going to be in business doing this as long as you need them to be to make sure your retirement goes from start to finish. So I used to try to prove, hey, the market can't be beaten, the market can't be beaten. Well, there's always going to be someone smarter than me that proves that, you know what, the market might be able to be beaten. The real question is that relevant to you as the investor, to me as the advisor, whether or not the market can be beaten? I'm here to say whether or not the market can be beaten is irrelevant, because for you to know and make decisions based on it, you're already behind the curve, and the correlation between past stability for mutual fund managers and future performance is 0. So track record investing is a myth, and as hard as it is, you need to ignore all the information to the right of the name of the fund. It just is irrelevant information to you. I'm going to further depress you by talking about the myth of market timing. Market timing is any attempt to alter or change the mix of assets based on a prediction or forecast about the future. And the myth is that money managers are able to utilize up and down markets and predict them effectively to gain returns and shield you from losses. And this is also a myth. The Dalbar research company tracks investor performance. Different than the numbers we were looking at a few minutes ago in the last couple of myths, Dalbar isn't tracking investments and their performance. They're tracking your performance with investments, okay? Because we know what the market's done over the last number of years. You know, since 1926, 8 or 9%. In the last 15 to 20 years, 8 or 9%. The market has produced that kind of a return if you take it on the aggregate. The average investor has done far less well. And we know how well they've done because it's a matter of recorded information when an investor buys and sells a stock or buys and sells a mutual fund. It's all there. All the information's there. And Dalbar has made it their business to know how well investors are doing using the market. So they track equity fund investors only, and they cast that against the equity index of the S&P 500 since 1992, 7.81. And for that 20-year period, The underperformance of the market has been more than 4%. 2.51% has been inflation during that period of time, and we're using the CPI, the Consumer Price Index, to measure that. Many people believe inflation is much larger than that. We won't necessarily get into that discussion until later if you want to. I'd love to stick around for coffee and negotiate that one. But why is market timing so difficult? Market timing is so difficult because the returns from the market are gained in such a short number or a small number of the total open days. If you take a period of time like the one we were looking at, October 1 to September 30, for example, a 20-year period of time, there are 5,040 days that the market is open during that period of time. Take away Saturdays and Sundays and President's Day and all the other days that the stock market's closed, and you have about 5,040 trading days. If you stayed in the market and just owned the S&P 500, those 500 U.S. companies, you can almost own them for free, you would have had a 7.65% total rate of return. You would have grown $10,000 to $43,000. Now, I think you could put this in your book if you wanted to. On page 8, the trading days gives you a 7.65% rate of return, and 10,000 grows to 43,680. Now, if you missed the 5 best days, this is academic. This wouldn't necessarily happen to any of you. You would have to be far less lucky than you could ever be. But if you just were out of the market for the 5 worst days out of 5,000, your return would have gone to 5.47%, and your 10,000 would only grow to 28,900 instead of the full 43. If you miss the 10 best days, you're down below 4% rate of return and a $21,000, $22,000 number, barely doubling money. And again, the average investor is right in this place here, doubling money every 20 years or so, when the market does it 2 to 3 times every 20 years. And in this past 20 years, believe it or not, and again, we're taking September 30, since September 30, it's only been positive. So if you remember the last 12 to 15 months, the market's been up, I think 13, 14, 15%, depending on how you're invested in it. So we're just leaving that out of it even, and you're losing. So you miss the 10 best days, and you take away more than half of the return that otherwise could be there for you. And so predicting the market and when those best days are is incredibly difficult, and I would say impossible to do for the average investor. And again, could Peter Lynch do it? Maybe he could, but again, is that relevant? Market timing doesn't work. So I get emails from financialplanning.com and from all kinds of other sources, and tactical asset allocation is a topic in those emails at least monthly. Tactical asset allocation you should stay away from as well. This is simply market timing with many different sectors. If you're looking at being in the market or out of the market, that's traditional market timing, but tactical asset allocation says, hey, we know asset allocation is a good idea, let's do that, but now let's sell small companies and buy large, or let's sell emerging markets and buy the developed international markets small, because we think that that's going to produce for us. Tactical asset allocation is like playing Russian roulette with 3 or 4 bullets in the gun rather than just one. Just far more reason to think that the manager could be making a mistake. They cannot predict the future with a stock or a bond choice. They certainly can't predict the future with multiple choices. And yet, folks are, quote unquote, rebalancing, they call it. And what they're really doing is they're trying to predict which market will do better, and they're loading up on that. We saw this a lot just prior to 2011 when Europe was in the news and Greece was really hitting the skids. Everyone wanted to get out of Europe. And we couldn't know. There's no correlation between this economic news, as you'll see in a few minutes after dinner. So tactical asset allocation is market timing. The word tactical is your tip-off. You should stay away from that as well. Charlie Ellis says, the evidence on investment managers' success with market timing is impressive and overwhelmingly negative. There is not an academic that will tell you that you can market time successfully as an investment manager, much less as an investor using investment managers' info. So the cost of investing are the fees incurred by investors to buy, sell, and own mutual funds. And the myth there is that what you don't see can't hurt you. In one sense, we all like commissions. We like commissions because we don't always see them, right? Sometimes we don't like the cost we see, even if it's less than the cost we don't see. And the devil is definitely in the details with respect to investing. There are bid and ask spread fees galore in mutual funds that come from buying and selling. And there are mutual fund wrap fees as well. I'm going to go through bid ask spread here in just a few minutes. And this is also in your book. You can look at the difference between the sell price and the buy price of a mutual fund. And what happens in the middle. The sell price of a mutual fund, let's just say, is $49.50. So Facebook, in his wildest dreams, could be $49.50 today, right? What is it now, 27 bucks? He's slowly making the climb back to 38 where he started, Matt Zuckerberg. But let's say he was at $49.50 today and someone finally said, okay, I'm going to sell. And he said, well, wait, talk to his stockbroker, wait, I'm going to hold on, I'm going to think about that for a little bit. And then he comes back, he reads an article or whatever, and he thinks, you know what, I think I'm going to buy instead. He calls his investment advisor back or his broker and says, hey, I think I want to buy Facebook instead. Well, then it'll be $50. He said, well, it was 2 seconds ago. I didn't see the price change on the computer screen. Why am I paying 50 bucks to buy and $49.50 to sell? Well, there's a commission that gets paid on every stock purchase and stock sale. And it's called the bid-ask spread, and it goes to the market maker. So when you see CNN's opening bell and the guy's running around down there with his little microphone and he's yelling up at the camera, I'm not sure why they always have to yell. It just raises my blood pressure. It's not fair. But they yell at the camera and they say, they open the bell and then they're standing by these big posts and they've got the big televisions around the post and everyone's running around with these computers on their shoulder and making all kinds of trade. These posts are owned by market makers, and these posts, I think 20 years ago, sold for $1 million each or $1.5 million each. These posts get the spread here because the market makers sell every stock through this post. If I wanted to sell a stock that I own to Mark Trumpy, I couldn't just sell it to you. I need to go through a market. This is good. It protects all of us. It makes sure that there's a property valuation. It makes sure that there's an ownership certificate. We're not just trading stocks between us. We have to go through a market. And that market takes a commission. So we want to pay a commission. I don't think the commissions are unfair. The problem comes when you start talking about the number of trades that are made. Remember, we talked about index funds versus active funds, right? There are two kinds of mutual funds, index versus active. The average index fund trades 20% of the portfolio every year. The average active fund trades 116% of the portfolio every year. What that means is the active managers are buying and selling stocks within your portfolio, coming to no benefit to the investor that's discernible, right? Because you buy it after they've had their run. And yet that cost is being borne by whom? You, the investor, because you're simply ending up with the net value of that stock after it's traded. So the cost of trading goes up as the size of the company goes down. This is a good reason why small company funds are rarely active traded funds and why rarely you'll have a true small company fund in your portfolio to choose from, because active funds can't trade small company funds with a 4% commission, round trip 8% commission to buy and to sell. So the large companies like GM sell at a few cents per trade, but all of it adds up to a lesser return for you unless they happen to beat the market with their trades. And again, we know that some will always beat the market. We just won't always own them, and we very likely will not own them prior to them beating the market. So Charlie Ellis again says the key questions under the new rules of the game is this: how much better must an actively trading manager be to recover the cost of their activity? And he says the answer is daunting. So far, myths are stock selection, track record investing, market timing. For some of you, cost of investing, everything you thought about investing is a myth. And that's not to depress you, but it's to say any positive change that comes to the investor needs to start with the truth. And what I just shared with you is the truth. It's not the easy truth, but it is the truth. So we're going to talk about the truth about investing. We're going to talk about the way that you can exit these four methods. So the true story of investing, we call it the free market portfolio theory. What is free market portfolio theory? It's an investment approach firmly grounded in research that spans now almost 60 years, 50 to 60 years. And it's a disciplined approach to investors. We talk about coaching as what I do and investment advising and coaching because your discipline is really what I'm after. I know what the market produces over long periods of time. I don't know what will happen next year, but I know that if you are undisciplined and you buy and sell in the market because of your fears or your anxieties or your greed, I know that you will underperform the market over time. And so I'm looking for disciplined investors to work with the market and accept its return, which has been tremendous. The components of this theory are free markets work, philosophically. Component 2, modern portfolio theory. And component 3, the three-factor model. And I get it. Free markets work is a statement in today's day and age that is not necessarily super popular, right? I'm not saying capitalism. Okay, capitalism has its positives and negatives, but I am saying freedom, economic freedom, is good, and free markets work to set prices. And I'll tell you what I mean by that. These are the folks we follow. Their names are in the back of your book, or I can send you an email of these if you want to read some of these people. And defined, free markets work is that at any point in time, the price of a security will be the best indication of its value. This is a belief that we will hold as investment advisors, that the current price of a security is the best indication of its value. Oftentimes you'll be driving home at night and you will hear that Wells Fargo or some company was just moved to a buy, or it was moved to a sell. It was downgraded to a sell, or it was upgraded to a buy. That means that the prognosticators out there believe that its price is off. So if something is moved to a buy, what they believe is that the value of the company is greater than the price, so you should buy it. Does that make sense? That's what they're saying. We don't believe that. I don't believe that's true. Now, do I believe that markets are perfectly efficient and the prices are always accurate? I don't believe that either. But this is how we're going to make investment choices, because this is the very best way to do it. There's no benefit gleaned in trying to find mispricings. We've already shown that in the last 30 minutes, that you can't beat the market in that sense. And anyone who's done it does it for too short a period of time for you to benefit from it. So the best indication of the value of a company is its current security price. And that's what I mean by free markets work to set prices. Consider if free markets failed. Then the market would fail to set these prices appropriately. It would be possible for some individuals to identify in advance which prices are inaccurate. Underpriced or overvalued markets could be forecast and predicted, and you could take advantage of these mispricings to increase returns and avoid losses. People with this view should use the traditional investment strategies that we outlined earlier. That's all you have to go on, is the traditional strategies that we outlined. If free markets work, on the contrary, then based on supply and demand, the free market is the best determinant of prices. All available information is factored into the current price already. New and unknowable information changes prices in the future, but that's it. I mean, if the market is forward thinking, if the general consensus is that something is going to happen, the market will price that in immediately. If Ben Bernanke is known to start to say, I'm going to raise interest rates on January 28, and it's January 15, if he says, I'm going to raise interest rates on the 28th, does the market wait till the 28th to change? No, it changes right now when we know it's going to happen, right? Now, if he raises interest rates the expected amount, now he's not saying he's going to do this, okay, so all of you with an equity line, I'm just supposing here. If he supposes he's going to do it by 1/4%, and then he does it by 3/8% or only 1/8%, the market shifts again, because he said he was going to raise it roughly 1/4. That was his expectation. So anytime there's new information, the market changes immediately. It's forward thinking, it prices it in. Only new and unknowable information changes pricing in the future, and the randomness of the market makes it impossible for any individual or entity to consistently predict the market and capture these additional returns unrelated to risk. Again, this is a philosophy, and partly what you're doing here, whether you know it or not, is evaluating mine, and this is mine. So if you come into my office and say, I think the market's going to shift in Europe and I want to get out of there, I'm going to say you can't know that, and no, I won't. And then if you say, yes, I will, I'll say, here's your account, go ahead and do it. I'm not going to help you destroy your wealth. You're going to have to do that on your own. That sounds a little callous, but we have to have that conversation now, because if we wait until you want to move the market, move based on predictions of the future, and then you find that I don't do that, that's not really fair on my part. So I don't imagine with a room this size I'm going to have a philosophical match with 100% of you. That's okay. I want to have a philosophical match with 100% of those of you who actually work with us. That's That's my job. So people with this view would utilize the free market investment strategies that we'll talk about. Beliefs dictate action. Free markets work, if that's your belief. Again, if free markets work to set stock prices, then we focus on capturing returns. We utilize asset class or structured funds. You could say index funds. You diversify prudently. You identify your risk tolerance. You eliminate traditional investment strategies. And you work with a coach or an advisor who believes these same things as you do. If free markets fail, then pursue traditional investment strategies. Stay connected to all sources of information, reading investment article after investment article, everything you can find. Work with a financial professional who shares your market belief. And most do. Most financial professionals are track record investing gurus. They will say that they work with the 5-star funds. They put an all-star team together. They compare it sometimes to next Sunday's, not next Sunday, but the following Sunday's football game where all the all-stars are playing. They take the best from every category and they bring them all together, and the best is dictated by their past performance. And that's traditionally how investing is done today. Modern portfolio, and this may be full, so there's plenty of room, but as folks keep coming in, if you've got a couple of chairs, invite others to join you so you get to know each other. Component 2, so free markets work. Component 2 is modern portfolio theory. Harry Markowitz in 1952 wrote the paper, and he was given the Nobel Prize for it in 1990 for a very specific reason. And here it was. He said, you know, we have information and data on the S&P 500, and we know that the return of the S&P 500 over the very long periods of time, I think this one is since 1973 that we're watching, that the return on the S&P 500 is between 9 and 10%. Now I'm going to introduce a new concept, and that is volatility as measured by standard deviation. Now, that sounds very mathy, and you don't have to be a math person to understand what that means. High volatility is a high number. Okay? Volatility is when your account does this. You've all experienced that in the last little while. And so S&P 500 has gotten almost a 10% rate of return over a long period of time with a pretty high volatility associated with it. Okay? Now, what Harry Markowitz said is that if you want to have that rate of return, you can get it by diversifying with a whole lot less volatility. Our moderate fund, for example, in 2008 went down 17%. The S&P in 2008 went down 39%. Over a 35-year period of time, 39-year period of time, they ended up at roughly the same place. The moderate fund was a little better off. Under which fund would you rather retire? I'd rather pull income out of this fund every month rather than this one over here where there's years or months where it's way down. So diversification works, and he proved that. He proved, and this was his first find, is that the asset allocation models over stock selection and other factors in market timing were 91 to 92% of the reason a fund performed. Okay? And it wasn't having to do these other factors, so he focused here on asset allocation. And then he put investments together, and he watched for correlation. Correlation, or another word is similarity versus dissimilarity. And if investment A and investment B act opposite of one another, they have a low correlation. A perfect correlation goes like this, okay? And low correlation goes like this. And if you own two investments that both start here and end here, but have very low correlation, your line or your returns annually are just like this, which is a whole lot nicer than being either one of the others. I'll show it to you here. He took the S&P 500, which had over a long period of time a 17.93% high risk deviation and almost a 10% rate of return. Okay? And he took away 30% of the S&P 500 and he put it into EAFE, which is Europe, Australasia, Far East. This is the international equivalent to the S&P 500. This is all large international companies. And he saw a slight increase in the rate of return and a slight decrease in the standard deviation. And then he took international small companies as 10% of the international large, increasing the return again, now 0.75% higher almost than it started, and a further reduction. Now, international small companies, I have to tell you, are very volatile. They're more volatile than U.S. companies. But when you put them with U.S. companies, the total volatility comes down, okay, because they act dissimilarly to one another. Does that make sense? So diversification works, and it works to reduce the volatility or to reduce the amount of up and down in the market for you. Now we're going to move to component 3, the three-factor model. Factor 1, 2, and 3, the market factor, the size of the company, and the value factor. I'll go through each one of these briefly. I think this is also in your book if you want to keep following along. We are on page 13. So what we want to do is we want to take risk where we're rewarded, and we want to avoid risks where we're not rewarded. So the risk we're willing to take is where there's a reward at the other end of it. We could market time. That's a risk, but there's no associated reward with it. We could track record invest. That's a risk, but there's no associated reward with it. But if we take stocks in an S&P 500 index fund over T-bills or CDs or the bank account that you have, you're going to get a better return. On average, over the long periods of time, equities are riskier than fixed income, but they beat the fixed income portfolios in return. Okay, so the rate of return since 26 is almost 10% in equities, and just over 3.5 in T-bills or the fixed income, which matches inflation, by the way. And the standard deviation is much higher as well. So you can take on more risk by going from T-bills to S&P 500, but you get paid for it. So I'm willing to do that with some of my money. Okay, that's the first question we ask. How much of the market can you be in versus fixed income? The second factor is the size of the company. Now we're comparing to large companies as well. The S&P 500, again, large companies are less risky than small companies. Small companies are more risky, but over time, small companies pay you for that. It's called a risk premium. I'm willing to take risk. Again, I'm willing to move some of my S&P money over into small companies, even though the risk is greater. I'm willing to do that because the reward is there, the return is there. So we're looking for premiums. I'm going to do a whole series after dinner on whether or not there are premiums, looking at all these different kind of indices that have been thrown at us in the news. And none of them show any correlational benefit to you at all, and I'll show you that. But here there is one. You go from the S&P 500 to small companies and you get a return. Now you go to value companies. Value companies I won't get into in great detail, but value companies are companies that are distressed, and they used to be called penny stocks. They're very low price stocks. You can get them inexpensively, and you need to own a lot of them. But when you own their index, again, you own a lot of them, they're riskier, but they pay you again for that risk. So the rate of return, again, is just about 2% higher than the S&P 500. They are a little bit riskier, but again, we get paid for that risk. So where do we get return? We get return from the market, and specifically in the market, we get the most return from small companies and value companies, and it probably won't surprise you that we get the best return from small value companies internationally. So we can put a lot of these together. Does that make sense? So when we look at that pie, you've got large companies, U.S., you've got large companies, international, you've got small U.S., you've got small value, you've got international small value. All of these are different sectors, and we can put them together for a portfolio. So free markets work to set prices. Modern portfolio theory is diversification in action. And the three-factor model is where we find returns or premiums. We put all that together, and you have the free market portfolio theory academically. But academically doesn't help you. You need to know that you could own them, right? So let's take a look at the portfolio. We're going to end with this pretty quickly, just in time. And in your book, you can put these together. This would be on page 15. So building a portfolio is a process, and my clients go through that process with us, whether they feel like it or not. They're going through it. I'm taking my clients through it. And it starts with the actual performance. So the first thing we need to do is analyze. One of the things you'll have the option of doing is filling out a card later to say, hey, I want you to analyze my funds. I want to find out what my current performance is. On average, investors out there are getting the Dalbar performance of 3.5%. And on average, they're getting a big up and down volatility ride to go with it. Most people have not been excited about their rates of return over the last 10 years, and most people have not been excited about the ups and downs and the turmoil they've gone through to get those poor returns. And the reasons for that is, again, because we're chasing after those five-star funds, we hold our stocks and our bonds and our mutual funds for a very short period of time on average. The track record investing, chasing the market, is done by all of us over and over again. It's worse done by investment advisors. Investment advisors, talking to you as investors, investment advisors are worse at this than you are. Their anxieties about their future income based on your behavior is worse than your anxiety. It is, we are as an industry helping you underperform. They would rather sell you out and go to cash if that's how you're feeling than teach you something and help you stick it out, or better yet, help you make a good decision about how much of the market you should own in the first place. Okay? Hyperactive stock picking and market timing and the costs associated with all of these things of getting in and getting out are all detrimental, and it's the reason why you're getting that low rate of return. So the first decision is to move away from active stock picking and move toward a market-driven fund like the S&P 500 or an index of some kind. And when you do that, and you move away from the from the rat race, and you just get into an index, your rate of return rises, and actually your standard deviation goes down, because there's so much volatility created by our own behavior that we can avoid. Portfolio 3 then is to say, okay, let's ask that first question, the market question. How much of the market should I own? And for sake of this presentation, we have portfolios that are all very different, and every one of my clients in a sense has a one just for them. But this one I'll just use 20% in short-term fixed income, 20% in 5-year fixed income, so these are bonds, and I'll use these indexes, and then 60% in the US stock market. Now this is always staggering to me. You drop 4% plus in the standard deviation of risk. This is a noticeable difference in the amount of volatility you have to live with in your stock market performance. And yet you did not drop that much in the rate of return. People always forget fixed income does still get a return. It might be 3 or 4%, but it does still get a return. And when you're rebalancing with it, which is a concept we'll get into later, maybe not later tonight, but later on, the rebalancing also creates a positive buy-sell arrangement over time. So that's portfolio 3. Portfolio 4, we're now going to introduce international large companies. And so we're going to split the US in half for sake of argument. And you drop a little in return because the international sector has done a little less well recently. And you pick up a little risk when mixed with those fixed income products. So portfolio 4. Now what that does though is it allows us to get into the international markets. And international small and US small we're now splitting with the international large and US large. And here we see a big jump in portfolio performance and not that big of a jump relative to the positive in the performance in the standard deviation of risk. So we have still quite a bit less risk than the S&P 500, certainly less risk than the average client's living with to start with, and you have a return that's now pressing up against 3 times as much. And then we add the value companies, and the value companies are exciting. They actually bring the risk down almost every time, depending on periods of time that you look. But if you look at any period of time that's 30, 25, 30 plus years, value companies act dissimilarly to other companies, especially when you take them the international value against the US portfolio. It does some really neat things. So you get the benefit of all of the returns, you get a little lesser risk. An assumption here is that we're rebalancing. Rebalancing essentially is making sure that as the market changes, these don't. Okay? So if international small does very, very well, it will become a larger percentage than 7.5, right? It will start to overtake. Well, we sell when they do well, and we buy the one that did less well. In March of 2009, our funds needed to be rebalanced. It wouldn't have surprised you, right? March of 2009 was the Dow was at 6,400 or something like that. It had been 14,000. Well, we sold bonds and we bought stocks. Exactly different than you would have felt like you wanted to go further into the stock market at that time. And we didn't know we did it at the bottom of the market. We just did it because our matrix was off by 2%, and that's what triggers it. So we rebalance. And on the way up the hill, we had more horses in the barn. We had more stocks in the barn. If you want to buy low and sell high every time, rebalance. Because rebalancing, not the way necessarily the entire world defines it, but rebalancing being keeping your mix where it ought to be, where you decided ahead of time where it should be, will constantly keep you buying low and selling high. That's what it does. So that's a better portfolio and a better performance than on the average we're getting. I'm going to do the 20 must-answer questions after the next seminar. So keep your forms open, and for those of you who came who are clients already, you'll have gotten a 20 must-answer question form. I would like to, hey, Liz, is dinner ready? It is ready? Okay. I'm not going to let you out by tables like we're at a wedding, but you'll all just be real civil and kind to each other. Maybe in this general area you go first and help everyone feel comfortable, and then just kind of file in line. It goes pretty quickly. Many are not doing well in this country. Many are overseas and would love to be home. For many reasons, I'm going to offer a prayer for our meal, and if that's okay with you, bow your heads with me, and we'll ask for grace.